All right. I think we're good.
I think we're ready.
Golden. We're unmuted.
Okay,
Here we go.
cool.
All right.
March 31st,
Last day of March
the last day of Q1, 2021.
and last day of March Cash Madness here on the Raw Take for CEOs. Now,
It's been a few weeks.
it has.
Took a pause.
I've been too busy with my March Madness bracket.
Did you do it this year?
And we always have a family competition.
Yeah.
So my two older boys got involved this year, and Christine and myself. So we all have a bracket. So far, I haven't checked it in the last 7 days. So that's not why we have not had a podcast for the last few weeks. But here on the podcast, we are doing March Cash Madness. Don't ask us about basketball. You won't get a comprehensive information, but ask us about cash planning, any of that, and we will have a slew of resources, information, and conversation for you.
Yeah. So good news this week. We just hired a VP Director of Accounting. I think we're super stoked for Jeff Stern out of New York City.
Totally stoked.
Totally stoked. We're excited. We felt like we always needed to begin to develop that leadership bench around accounting, as we've done with FP&A and we've done that with tax. And so we're excited for Jeff. He comes with many years of experience, CPA, forensic accounting, litigation, audit, tax, total rock star. And I think this is going to bring a second wave of growth for us in 2021. Obviously, Stephen Cummings has been totally killing it on the tax side. So yeah, we're excited coming out of Q1 with great news, good momentum, and heading into Q2 with at least three new hires coming on. So anyways, that's enough about us, but wanted to share that. So that's why we haven't done the podcast. Let's face it, in the last 2 weeks, it's been busy.
We've been busy, and we take our own medicine, right? It is all about planning. It's all about taking advantage of opportunity. And when we had the opportunity to bring Jeff on, we jumped at it when we were able to move quickly. That is why you put the effort into planning, because it's not whether you're going to pull the trigger next week or not, but when the opportunity comes along, you can move quickly. Yeah, I mean, that was probably one of our quickest hires, I would say, and one of our more senior hires as well.
Yeah, no, I'm totally excited. It's funny because we were thinking about planning and budgeting. I just had a conversation with a startup out of New York City today, and and this is not the first time I've heard it, but it's her comment was, "Yeah, we have a budget, but the budget's always changing." And I said. And she paused. She almost like interjected before I was going to jump in, and she said, "I get it, and it shouldn't change, but it does." And I said, "Yes, the budget doesn't change. It's the realities of the business that change, but the budget's the budget. And why is it the budget? Because that is the line in the sand. Because whether it is an opportunity to hire someone that wasn't, say, in the cards in the first half of the year, maybe in the second half of the year." Doesn't mean you have to wait until the second half of the year, even just because your budget says, no, you cannot hire in Q1, Q2, you have to hire. It doesn't matter. Mm-hmm. It's a question of, in my current paradigm, my budget, one, do I have the business to hire? Do I need that additional resource? And secondly, do I have the capital to go and execute on that plan? And I get it, like with a lot of business owners, it just feels a little not so agile, right? It feels a little too rigid for a lot of folks, but it's
yeah, and I think if I can jump in here, I think that's where the budget lines up with cash flow planning, right? Because your budget is your budget, to your point, Dan, right? That is your plan. I'm going to execute on this. If there's an opportunity that comes along, or if there's a risk that happens, I need to be able to respond to that. So hopefully I'm thinking about that, which is my point. Like when Jeff came along, we were able to respond quickly, right? But it doesn't change our budget. It does change our our cash profile in 6 months, right? Because we need to get him up to speed. You know, there's an investment in people. So your cash planning is what gets adjusted on that agile basis. But your budget doesn't change, shouldn't change, except for those major milestones, whether it's halfway through the year, you adjust your budget, or you raise 20 million bucks instead of 5 million bucks, you're going to change your budget, right? So something monumental has to happen to make it so that you need a new plan. Right?
Yeah, and I'll just add like one other layer here. It's very rare that a budget will have, say, an acquisition in the budget. It may be a goal for the year. It may be, you know, I'm expecting X amount from organic growth, X amount from acquisitive growth, but you can never actually put an acquisition into a budget. It's like square peg, round hole. So it doesn't mean you can't do an acquisition because it's not in your budget. It doesn't mean, you know, if you don't do the acquisition and you have numbers in your budget, in other words, a gap, and you're compensating people based on the budget, then it is up to management's sort of responsibility, execution to figure out how to close that gap. If it doesn't come through acquisitive growth, then it's going to have to come through some other means. So anyway, so this kind of brings us to cash flow modeling, which is kind of the last theme of March, cash madness. We talked a little bit about KPIs. We've talked about visualizations, you know, how to visualize your cash movements. You know, it is not uncommon to get a question from a business owner that says, I know I made $100,000 in net operating profit, but my bank account really hasn't changed from last year. So, you know, I like certain visualizations to be able to explain to folks like, yeah, it didn't hit your bank account because you did X, Y, and Z, and you get to actually you get to see it. I think through modeling, you get to actually experience it, and you get to understand the underlying drivers of the decisions that you have to make with that profitability, right? Pay down debt, refinance, make that acquisition higher, whatever it may be. So I love modeling.
Yeah, and it's you know, modeling is where that kind of visualizations, kind of looking back what happened, and the KPIs. What are the things that I can measure, right? Where those comes together, because hopefully you're doing some forward-looking cash modeling. And what happens if I put extra effort into pulling in receivables, bringing my days outstanding from 60 to 45? What does that do to my cash profile, right? So it's the intersection of the outcome of, you know, where did my cash get sucked up, and if I change these metrics, these KPIs, how does that impact my cash profile down the road, whether that's 30 days.
Or
13
hiring,
weeks or 12
adding
months.
more resources, software, right? Because your days outstanding doesn't go from 60 to 30 just because you want it to, right? There's effort, there's resources, there's capital that needs to be allocated towards that. And so we talk about modeling in kind of like two general buckets. It is a lot about, you know, sort of, if you were to look at the profile of our 200 plus customers, you would see it's pretty much split down the middle between startups and scaling emerging venture-backed companies and more traditional operating companies, although skewed more towards entrepreneurial. And we have to approach those two personas through the lens of modeling very differently, very unique, right? So I'll touch on the operating, and you can touch kind of on the startup.
Yeah.
On the operating side, I'm looking at maybe one or two things. One is that cash conversion, right? Cash conversion cycle, your free cash flow margin. I'm looking at the free cash flow, right? And then secondly, looking at, in order to feed the growth, which is not like exponential growth, it tends to be more incremental growth. Do I need a new machine? Do I need another truck? Do I need that piece of more traditional capital planning, AKA free cash flow, or debt, or worst case from the owner's pocket, right? And so in startups is totally different.
Yeah, and I think two main reasons we do it for kind of operating companies. One is when things are tight, you need a very tactical like approach to managing cash, and the other is that planning side. Need a new person, need a new piece of equipment, or, you know, end of year like tax planning. How much cash do I expect? What am I going to do with that?
Yeah, I get totally like weirded out when I hear a startup doing 13-week cash flow planning.
Yeah, no, it happens.
And it happens, but you kind of think about it, it's just like, unlike, yes, a startup can maybe has a little more elasticity in the throttle, but they have to burn cash to get to point A, point B, whereas an operating company, the 13-week cash flow is much more blocking.
The reason why, when you say 13-week cash flow to startup, it means that they're totally running out of cash.
Totally
Right?
right.
A operating company, maybe it's they need to pull in a big invoice, to make it through those 13 weeks. But for a startup, it's going to be they are burning cash, right? That is what they are built to do. It's raise 2 million, 10 million bucks and get to a milestone, right? And if you don't get to that milestone fast enough, you burn through the cash, you're up a creek. And then in the last 3 months, you're doing 13-week cash flow planning, trying to cut your expenses so you can find, circle up some investors to give you some bridge financing and get you to that milestone, right? Startup financing is all about milestone-based financing, right? I'm not going to give you what you need to build for 10 years. I'm going to give you what you need to build for a year, 6 months, 2 years, so that you can prove to me that you can execute and get there. And if you can prove to get to point A, then I'll finance you to get to point B, right? And in terms of like the cash modeling, the biggest metrics are your cash burn, your cash out date. When do we turn cash flow positive for companies that are trying to grow, have met that product market fit? They're actually generating cash. Have that inflection point to stop burning cash and start being more like an operating company, start generating cash.
And so in startup world, I look at modeling through two lenses. One is that 3 to 5 year plan with, what are the drivers, the derivatives of that plan, the scaling factor. And then the second piece is all about the liquidity, right? And breaking that liquidity needs into multiple tranches, like you just mentioned. How do I get from point A to point B? And then how much cash do I need? And then lastly, okay, how much time realistically do I need in order to achieve, to raise additional capital? Whereas on the operating companies, yes, the annual operating plan is important. It's important for multiple reasons. I would say it's important to understand the growth trajectory and the cash needs. But those cash needs aren't like long-term cash needs. They tend to be shorter term in nature, especially if you're in a service business versus, say, manufacturing. And then layering on the debt needs of that business. Because just like a startup may need a good 3 to 4 months to truly raise that next round. I mean, they're like always in capital raising mode. Even regular businesses need time to have conversations with bankers or private equity, lawyers, and et cetera. So.
Yeah, I think it's helpful to look at, what do you do these cash flow modeling for? One is to run the business, operate, and the other is to communicate with your stakeholders. And startups, it's your stakeholders are your board and your investors. Often those are the same audience, or at least 50-80% overlap, which has its own challenges. And on the operating company side, it is for operating the business, and your stakeholders are your banks, right? And we've had a lot of positive feedback from what we've done with our customers on the cash flow planning, modeling out the business. What does this look like? Because banks don't usually get that level of engagement because they don't usually get that type of reporting from their portfolio customers.
Yeah, what I like about modeling, whether it's startups or operating companies, it's it's about the story, but you need the cash to kind of back up that story. And you can throw a bunch of slides up and talk about how great you are, the type of customers you have, the gross margins. But if you're not able to actually take that and extrapolate it out and be able to have more rigor around your cash management, and then also be able to operationalize some of that cash management. In other words, like working capital, AR, AP, inventory. I think it just adds a tighter foundation to your business, and it adds that cadence and that rigor that regardless if it's bankers or private equity or venture capital, it's important to have that, I would say, to communicate. So, and it elevates the confidence in your story. So
cash is king.
Yeah, cash is king. And so on the operating side, big fan of 13-week cash flow, especially in tight times where debt service coverage is tight. Margins may have, if during inflationary periods, margins get tighter, or worse yet, when you have revenue slowing down, but yet, you need that revenue to cover your costs. I think the 13-week cash flow just adds a little bit more rigor and sort of take a step back and watch the cash coming in, the cash coming out. And it's less about planning, to be honest with you. And I know a lot of people use a 13-week cash for planning. I think it's more about keeping the finger on the pulse of the business. But I wouldn't say that is more important than, say, a 12-month cash flow plan that comes out of your annual operating plan. And then being able to use your, these sort of ebbs and flows of the business, the risks and opportunities that pop up throughout the year, going back to that cash flow plan. Like the cash flow plan isn't the budget, right? The budget's the budget. The cash flow plan is the
result of that budget.
It's a result of that budget, but also the result of the realities that business owners are facing.
Yeah, to your point, 13-week cash flow is not about planning. I think, we look at it more as a dashboard, right? Sometimes it's about planning. If it's about planning, it means you're in desperate situations, right? But it's more of a dashboard that you're going to look at on a weekly basis to kind of see the health of the business over the next 3 months.
Yeah. So
on the venture side, often the conversations go to what is my cash out date, right? Just the same as like the 13-week cash flow. That's a little bit of the dashboard, right? What based on my current burn, my milestones, my expected plan, what is my cash out date? So when it comes to CEOs, it's the CEOs that engage with their plan, their budget, knowing what it is, knowing what the drivers are. Those, I really appreciate when they dive in there, right? Sometimes they're just focused on top line revenue, right? And that's fine. They're a salesperson. They're going to be out there. But somebody in the organization needs to be focused on what is this whole plan and how do we make sure that we're executing against it. And therefore, when we're in conversations with the board and in conversations with the management team, knowing what those levers are that we can pull to make adjustments if we need to.
Yeah, on the operating side, one of the things that really drives me crazy, and maybe it's a sign of the times, the last 5-8 years, how sort of ubiquitous the venture community is just in business in general. And it's like, I sometimes find myself having conversations with operating companies like, you're not a VC-backed company. You're not a scaling startup. You have to achieve you need to focus on becoming a free cash flow machine. And doesn't mean that you're not making investments in the business, but the fundamentals of the financial fundamentals of the business, revenue, cost of goods sold, gross profit, operating expenses, net operating profit, free cash flow, that needs to be intact. I don't expect a scaling startup that has a 3 to 5 year product development horizon, customer acquisition. Like that is a very different beast than an operating company, regardless if it's service or manufacturing. Like that income statement, that P&L, that free cash flow, that thesis should be intact, regardless of the investments you're making into that business. And sometimes I feel like on the operating company side, some of these business owners, visionaries, they think they're more like a scaling startup versus no, you're running an operating company. Investments flow through your balance sheet. Financial performance is recognized on your P&L. Don't give me that shit. Like this business should be making money, regardless of the investments that it needs. And I'm a little passionate about that because it's like, I'm trying to get folks to understand, like, there is a rigor to this. There's a thought process to this. And that has to flow into strategy. I had a boss once, 15 years ago. He said, Dan, the most important thing you need in business sometimes is just get the damn nomenclature down, right? So there's things don't get lost in translation. So anyways,
It's so true, nomenclature. I one kind of last thing, but to your point, the P&L for an operating business needs to be fairly consistent, right? You need to know what your gross margins are. Those should be pretty. They should plot along, right? You should not see a lot of volatility in that, even down to your net operating profit, unless there's major things going on in the business world or in your business. Those should have it on your balance sheet, to your point, right? And I think the conversations that we often have with the venture-backed companies, it's less about gross margins, what operating expenses. It's about where am I spending my cash on a functional basis, right? Is it in product development? Is it in sales? Is it in marketing? Is it headcount? Is it machines, right? That's all. Those are the conversations. So that I think often what we deliver to operating companies versus venture companies looks a lot different in terms of cash planning, because the buckets are different, right? The buckets for an operating business are more of the financial statement buckets, and on a venture-backed business, it's more about where am I spending those monies, who am I spending those monies on, and therefore which milestones am I trying to achieve, or where am I investing to achieve milestones right now?
Agreed. So my key takeaway on the operating side before we end it here is get your annual operating plan in place, convert that annual operating plan into a 12-month cash flow, include a bucket for investments, which is very different than a P&L or an income statement. And then lastly, if you feel like you need it and you feel like there is a lack of rigor in your cash management, get onto a 13-week cash flow and hopefully get off of it soon, because the 13-week cash flow, it is time consuming. It takes a lot of effort. And I don't think most CEOs even come close to appreciating the amount of time that it takes to manage this, what I call a hidden factory, because that's what a 13-week cash flow is. I've yet to really find a system that integrates well with AP. I know guys like Bill.com and QBO and cash flowing, there are systems out there, but they don't really do a great job of managing 13-week cash flow, because at the end of the day, it's still very tactile. So
very
cool.
All right, that's it for March
Happy
Cash Madness.
Happy Q1. This today looks very different than it did 12 months ago. Although 12 months ago, we are probably coming on the anniversary of our first year of doing this podcast and doing it live, and we've done different iterations. We're going to be looking forward to marketing in 2021, and some of the things that we're working on, I think, are kind of cool. So
yeah, we're putting together the episodes for April, looking to focus on startups. So April's going to be startup month here on the Raw Take for CEOs.
Yeah, and last week we had Partners Week. Our marketing team was out there pumping up social media around some of our partners in the ecosystem, as I call them.
Yeah, it's fun.
And it's fun, and customers and potential new customers, they actually love the fact that, yeah, we do a lot under one roof. Although what we do is, we try to keep to our segment. We know what we're good at. But having friends in the ecosystem to be able to point our customers in the right direction to get the expertise they need, I think that's been a great added value to our value proposition. So totally stoked about marketing's team effort around Partners last year. Cool. And on that note, end of Q1. Thank you. Nice job. Thanks, Ed. Thanks, everyone.